Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500, and I think it's going to be quite a controversial video today. I often get a lot of questions regarding my pessimistic view on the long-term performance on the equity markets, more specifically the US equity markets. I've often stated that I expect the next bear market to be particularly violent, particularly large. And in this video, I'm going to be demonstrating step by step why I think that's the case and why the next 5 to 10 years on the US equity markets might not be as fun as the last 5 to 10 years that we've seen. And if you have any comments or any feedback on the things that I put out in this video, make sure to leave a comment down below. We are always looking for counter arguments and to put our research to test to see if this is actually the most probable outcome for the US equity markets. And also keep in mind that this is about the next bear market. We're still in a bull run here. We're still in an economic boom. And as we've covered in most of our recent videos, we think there's still quite a bit of room to run on the S&P 500 before we reach any type of long-term top, and very likely to see the type of rallies that we haven't seen since the 1920s, really where the market goes absolutely parabolic. But that's exactly why we do these videos. We take a look at the markets, we take a look at the data every week, every month, to see if anything has changed, to see if the macro environment is still telling us that we should be invested in US equities. So after this video, you'll know exactly why we expect the next crash to be absolutely devastating in terms of stock market returns. You're also going to know exactly what indicators we're looking at that are going to tell us when we're approaching that long-term top, and potentially how to benefit from this type of market move. If you're interested in following these crazy markets with us, make sure to click on that subscribe button. And now without further ado, let's get right into it. Now, the first reason is hidden in the S&P 500 earnings yield. Now, this is not just the normal earnings yield that a lot of people take a look at, but it's the real earnings yield that's adjusted for inflation. So what this is telling you is how much your share of the S&P 500 is earning relative to its price. So that gives you the return on investment relative to the price you paid for it, and it adjusts that for the inflation rate. And you can see this is a fascinating chart because every single time you see the S&P 500 earnings yield dip into negative territory, that usually marks a very long-term top on US equities. It happened in 2008, in 2000, in 1990, in 1991, in 1980, and 1974. And you can see all of those dates systematically correspond to major market tops because it tells you that the S&P 500 is particularly unattractive there and that it's due for a correction. We do have an exception with 1991 that did not trigger any type of long-term top. And by the way, in 1980, it might not seem like a big deal here. It might not look like a very large crash, but when you adjust it for the inflation rate, right, this chart adjusts the S&P 500 for the inflation rate, it was a pretty violent move down here. This entire period was extremely volatile on the S&P 500. Now, the second reason is US profit margins. And this is a very important one to understand. When profit margins go up, stocks perform well. But you can see profit margins don't go straight up forever. They have a cyclical aspect to them. And once they deviate too much from the trend, they tend to come back down. So what we've seen throughout 2020 and 2021 is that profit margins have been expanding massively. And that's a large part of what has driven the stock market run. But that also leaves a lot of vulnerability for this to come back down. And that would have significant impact on the stock market like it did in each of these periods here. Now, also keep in mind that when you look at history, when you look at the last 100 years of corporate profit margins, we're at all-time highs here. So not only are we relatively elevated in terms of the short-term trend since 1985. We've seen a large increase in profit margins very rapidly, even faster than leading up to 2008. But we also have profit margins at all-time highs relative to any other moment in history. And that leads me to the third reason, which is corporate taxation, which is currently at an all-time low relative to GDP. Now, if you remember when Trump was elected in 2016, he lowered the tax on corporations, and that created a large move up on the equity markets. Trump was elected in November 2016, and right that day, that same very day, you started to see a massive equity rally leading up to a blow-off top here in 2018. That was investors pricing in those tax cuts, those increased profit margins, and leading the SP 500 to higher valuations. So again, long term, that leaves a lot of room to see those profit margins go down as we see tax increases. The last time we had significant increase in taxes was in the 1930s. Governments tend to increase taxation on corporations when they see large wealth gaps. When there's a lot of inequality in the system, many rich people, many poor people, they need to increase taxes to redistribute wealth. That's exactly what happened in the 1930s. You can see in the 1930s, income inequality was extremely elevated, very similar to the levels that we've had throughout the decade. This is a chart from 2010, but it does illustrate that very clearly, and inequality hasn't gone down since. We're now seeing Biden talk about increasing taxes, having a global tax policy. We're leaning a lot more towards seeing increased taxes rather than having another Trump phenomenon where we see lower taxes, which helps push the equity markets higher. That's highly unlikely. So this doesn't predict a crash, doesn't really mean anything other than the government's ability to lower taxes is a lot smaller than its ability to raise taxes. And what the government usually does when it has inequalities like this in income, it tends to favor increased taxes, which definitely tends to hurt corporations, like it did in the 1930s, by the way. Between 1934 and around 1940, you saw this increase in taxes. And look at what stocks did. They did absolutely nothing. They went sideways throughout that entire period, despite elevated levels of inflation. So that crash was actually a lot worse than it looks like here. If you look at the inflation adjusted chart between 1934 and 1941, the equity markets almost lost 50% of their value. Now, reason number 4 is valuations, and this is the PE ratio. So very similar to the earnings yield that we talked about at the beginning of the video. And I'm not going to talk too much about it in this video because I am going to be making another video specifically talking about stock market valuations. But look at this. The median PE ratio of the top 10 members of the S&P 500 is at the same levels as in the dot-com bubble. Now, that doesn't predict a crash. It doesn't mean anything in the short term, but it tells you there's a lot more risk than there is for potential reward. And that opens the door for volatility. Now let's talk about reason number 5, and that is margin debt to GDP. This is the balance in margin accounts relative to the gross domestic product. And you can see we're currently at 4% here, higher than at any other moment in recent history. There's some evidence that in 1929 we were at around 6% of GDP. Now again, remind yourself, this is not predicting a crash. A lot of people use margin debt to say, oh, it's okay. Now we're about to crash. We're about to have that big bear market everyone's been waiting for. Nope. That's not how it works. This is just telling you that investors are leveraged long. Investors are betting that the stock market is going to go higher, and they're increasingly taking more and more risk as we've had the stock market perform extremely well and give good returns. So again, it's a question of risk relative to reward. Now, of course, that's a big part of what we do on our service at gameoftrades.net. We look for assets that have much more favorable long-term risk rewards, both from a value standpoint and from a technology standpoint. I think there's some tremendous opportunities out there for investors who have an open mind and that are willing to take a look outside the traditional financial system. If you're interested in checking out our articles and the research that we have on these various assets, make sure to click on the link down below to test out our free trial we have. We really have a growing community of members here. It's just amazing interacting with this community of investors, sharing ideas, getting feedback, and trying to navigate this market as best as we can. Now, this leads me to point number 5, and this is probably one of the most important points, and that is the federal fund rate that is currently at 0. Now, typically what has happened throughout history is that when the economy slows down, when you run into a recession, when there's some bad times that occur, the Federal Reserve has the ability to lower rates, stimulate credit, stimulate economic growth, and keep assets trending higher. And that's been the case since 1980. Systematically, every recession, every downturn, the Fed lowers the rates. And we have not seen a downturn happen with the Federal Reserve fund rate at 0 or practically near 0. So I think that we're slowly coming to the end of this 40-year cycle that we've had since 1982, where investors have had the confidence that the Federal Reserve can lower rates to stimulate asset prices. It's not the case anymore. They have no capacity to lower rates. Now, I am going to get comments saying, oh, the government can do more stimulus or they can do more QE. But the problem is that debt monetization, so stimulus and QE, creates inflation, as we've seen throughout the past year. And so the Fed has to taper. It has to reduce its fiscal spending until we see inflation turn down again. And what often happens, and what I think is going to happen now, is that inflation begins to turn around very late, right? Look at this. Inflation peaked in September 2008. The markets in September 2008 were already 40% down. So that leaves a lot of space once the momentum shifts, once the macro begins to turn around and we have investors leaving the equity markets. It leaves a lot of space for a move down in equities before the Fed can react, before the Fed can say, oh, okay, inflation has slowed, and now we can begin to do fiscal spending and quantitative easing again. And once they do that again, we'll be bullish on the stock market, and that will be the moment to re-enter. Now, those are the 6 reasons why the next stock market crash is very likely to be devastating. This video did take some time to prepare. We have lots of research, lots of data going into this. So if you enjoyed, make sure to click on that like button. And in the meantime, I wish you good luck on your trading and see you next time.